Hello and welcome. My name is Jeffrey Kennedy and welcome back to another episode of Elliott Wave Junctures. If you recall, last week we spoke about a very traditional technical chart pattern referred to as a head and shoulders. That head and shoulders pattern was first popularized by Edwards and McGee in their seminal work, or their wonderful book, Technical Analysis of Stock Trends. Now, with respect to its actual formation and construction, very, very simple pattern here. You have a left shoulder, a head, and a right shoulder. And typically what we do in a bearish reversal pattern, which is what this structure would be in the euro, is you draw simply a trend line from the extreme here, or that low that occurs between the left shoulder and the head, over to the low that forms between the head and the right shoulder. Now what you can do early in the formation here is actually take a parallel of this trend line, which is referred to as the neckline, off the actual left shoulder, and often that gives you a resistance for the formation of the right shoulder. Notice what subsequently happened in the euro is that we came down and then bounced right back up to the center line. That's referred to as a shortfall. Now, ideally, what we will see in this market is just prices to continue lower down to, say, the 125 even handle. But we may see something more elaborate here along the lines of a classical Elliott wave structure, in which case I'll be looking for a small pullback to test the trend line that ideally will break within the next, ideally, say 3 to 5 trading days. Because again, what we need to see in this market to confirm a breakdown is this kind of a price action, daily decisive closing price action below the neckline. If we can see that, that opens the door for a move all the way down to the, say again, 125, 125.50 handle. Now, part of the reason why I'm revisiting this pattern in the euro is, number one, I still think it's very viable still. Okay, but also too, there's a few other things that I think are interesting that I'd like to point out, because remember, and this is very important to remember, technical analysis or the different types of technical analysis you do not have to use in isolation. You can combine candlesticks with, say, MACD or RSI. You can combine the wave principle with trend lines. You can combine the wave principle with RSI. You don't have to utilize these tools in isolation. So, for example, what we actually have here in the euro is a bearish head and shoulders pattern that, again, requires a nice decisive daily closing break of the neckline, i.e. a move below 130, and I think that'll open the door for a move all the way down to 125. But what's interesting is if we take a look at, say, an inverse currency, this would be the dollar index. Okay, well, look what's going on here. We're actually seeing the formation of a morning star candlestick pattern. This is a bullish. So what I'm going to actually look for here is for prices to continue to go higher. And also, too, notice the other day we actually saw a bearish dark cloud cover pattern right here. This is a possible failed bearish dark cloud cover pattern. The reason I say possible is because, number one, it really hasn't been confirmed. We haven't seen the market push lower here, and essentially what I'll be utilizing are the extremes of these candlesticks here as the levels at which I'm right and the levels at which I'm wrong. But bottom line, if we can see some more rally in this dollar index, that will equate to further decline in the euro, i.e. that break of the 130 handle. And again, that'll open the door for a move all the way down to 125. And I think that'll clear the way for a move up in the dollar index to above, say, 81, and actually put some pressure on 82. Another reason I'm actually talking about the euro again, and number one, is to kind of refresh your memory about the head and shoulders pattern, but also show you the morning star reversal, bullish reversal pattern on the daily price chart of the dollar index. But if you recall yesterday's lesson, we were looking at the double closed key reversal outside bar combination bar pattern. Okay, well, this is what we have in the dollar index on the weekly level. Here's my outside bar. Notice the high is above the prior weekly high, and the low is below the prior weekly low. But also notice the close is above the prior two closes. This is exactly the type of reversal pattern we talked about yesterday. This is the bullish double closed key reversal outside bar combination. Now, if you recall, there's the way I actually look at this from a trading perspective is I want to identify the extremes of the actual reversal bar, and that would be this bar right here, that first week in April. The high of the bar is 80.177, the low is 78664. So essentially what I'm doing is I'm doing the ready, aim, fire technique or approach here. So what I'd like to actually see is nice decisive weekly closing price action, because this is a weekly price chart, above that 80177. Once that happens, that'll essentially essentially be my trigger. And rather than actually running the stop at say potentially at say 78,664, you could actually probably get it a little bit closer, even tighter, because this is a weekly price chart here. But bottom line, this is the potential that's actually building in this market. And again, don't utilize, or I typically don't like to utilize technical tools in isolation. I like to combine them. So what do we actually have working here? Well, we have a bullish double close key reversal outside bar combination on the weekly price charts. The levels to trade against are clearly evident. 80.177, 78.664. That's the weekly chart level. If we look at it from a candlestick perspective, we have a 3-candle candlestick pattern in force. Number one, this is the morning star, and it's on the heels of a possible failed bearish dark cloud cover pattern. As I've written about before in Traders Classroom in my monthly futures junctures newsletter, sometimes the best buy signals are failed sell signals. Possibly this is what we actually have forming here. And of course, the classic head and shoulders pattern, which simply requires a nice decisive daily close below the number one, the neckline, and roughly say that 130 handle. And if we can get that, I think that's going to open the floor down to a move all the way down to 125. So I wanted to just kind of bring you up to speed with what I'm looking at with respect to the currency markets. And as always, if you're interested in, say, the pound or the Swiss franc, Jim Martins is your guy. He's the editor of the Specialty Services Currency Product, and he can certainly get into much greater depth than I can here with respect to Elliott Wave junctures. But again, exciting opportunity, exciting time in this market here, because we've been looking for something big and something volatile right around the corner, and it could be just, again, 3 to 5 days away. Thank you so much. Good night.